The U.S. Treasury under Secretary Scott Bessent stepped in last Friday, July 31st, to support the Japanese yen, right? Shot past that 160 mark that a lot of followers have been tracking over the last few years. So in isolation, this intervention can look like just another move in the currency markets. But in the bigger picture, I view this as a major step in this larger transition that has been building up steam for really decades. So, in hindsight, I'd expect this FX intervention to go down on the record as a catalyst event that opens up the, the system, right? Financial, geopolitic, international trade, everything to move into a next phase in this kind of big restructuring of all of those things: international trade, cross border capital, finance, government power, and the alliances between those sovereign states that make up the nodes in the system. Um, so, right now, with the fog of war, kind of makes it hard to see the full significance of this yen intervention event in real time. Um, Really, the discussion in the public forum has moved to, let's just call it, mudslinging this week, as we'll get into discussing. Um, but most of the coverage and discussion around this event um, that you'll get, dealing with this topic at a surface level. I think right now it either looks like an episode of Real Housewives, like Scott Bessent, Nick Timiraos, um, or it's like a doomerism horror suspense thriller, like Stanley Kubrick, Alfred
Everything's
Hitchcock,
bad.
whatever,
Yeah.
about the inevitability of a yen collapse or a Japanese sovereign government debt collapse. Um, I don't think either of those kind of treatments do proper justice to what this intervention is in that big picture context. Um, I think it represents, like, not just an important marker, but a key bridge that has to be crossed on this road towards a new monetary structure, right? For everyone involved, the Americans and the Japanese. So we'll get into that. All right. So a lot of the social media treatment is framing this intervention as some sort of like omen of the yen's looming inevitable collapse. And that's understandable, I think, just given that Japan has now spent decades dealing with the monetary aftermath of the Nikkei bubble collapse in 1990. So everybody knows about repeated quantitative easing. I think they've done something like 20 rounds, negative interest rates, and just a long domestic economic depression. Um, but that doomer framing is really just like caught up by the problem, the paralyzation of horse blinders. Um, I think what it's doing is myopically focusing, like looking for the death of the thing while ignoring like the facts of life. What comes after death and the decay of the process is always followed by life, rebirth, etc. So in monetary history framing, the crash event or the death event creates the underlying soil for that later restructuring and rebirth to take place. And I think right now the doomerism is miscataloging the facts, or misreading reality, misinterpreting reality. Japan already had its 1929 style crash when the Nikkei bubble collapsed in 1990. Like in my view of the historical tape, or record of fact, um, that was the true destruction event. We saw fortunes disappear, wiped out, and never come back for the people who held them. Right, Japanese savers, investors, speculators, right,
Hmm. Yeah.
who were just completely wiped out. So I think of the decades after that collapse in 1990, like can be understood as the first phase of the yen trying to move from that death towards a rebirth out of the collapse. So the comparison I would make is to the long restructuring process of the U.S. dollar system after 1929. We're not going to go through it here; they'll just eat up all of our clock. But we're in, we're still in, I would say, that process, like within the offshore dollar system itself. But we're at the final tail end. So we've got two rivers like meeting, converging at a confluence here. Um, so that transition we're beginning to see now in the yen with this Yentervention event is now touching on that transition that we talk about on Mindprint Hash, from the offshore dollar to the new thing that is emerging. We think it's the stablecoin asset dollar. But talking about that convergence is really just going to be the core of this episode. So I want to start from the very ground level here, like thinking about the word yen and just build up from first principles. Um, the word yen was picked for the currency's name, um, like pulled out of thin air. But what we think of as currency, a unit, started centuries ago, 1870s during the Meiji Restoration. But the word yen is pointing at the idea or concept of a circle or something round, and what it's really reaching at is the same monetary ideal or Platonic form as words like dollar or yuan are attaching to. Its value packaged into a standardized unit that can circulate, facilitate trade, etc. So, like I said, this modern yen, it's 150 years old. Um, it was really started as similar to what we're dealing right now, death and rebirth. It came out of the Meiji Restoration. I'm not sure if I'm saying Meiji correctly.
Meiji. Yep.
Meiji. Okay. Um, as Japan was working to create a monetary unit or standard of value that could interoperate with Western standards and the global trade, capital markets, etc. So the purpose was practical and civilizational. You want to facilitate trade, improve quality of life, allow profitable business and enterprise to grow, and then expand economic interaction beyond your previously limited domain, right? And that, like, thinking about that at the root is kind of revealing about what's going on here today as just like one latest chapter of events in a bigger picture story. Um, the money, what we're actually trying to do as policymakers is it's an intent to build a tool that brings order and reduces chaos by like hoping, like the hope is provide kind of a backdrop, a context where all of those good things we talked about can foster and develop. All right, so just want to keep that basic framework in mind when you see the interventions in the near future. This isn't just a story about Scott Besson or Nick Timiraos like duking it out on X and social media. It's not just a currency chart or a trading position. It's a story about a civilization trying to create order out of chaos through money, right? Through establishing a defensible and viable sound. I don't know, sound. I don't want to use that term. It's loaded, but a monetary framework or system. So that struggle to build a workable and defensible monetary structure. This is like what we're looking at right now. It's both a Japanese story and an American story, and these two paths are converging. And I'll get into that here. So we'll go to the chart. This has got a lot behind it, but it's worth spending time here. So the current exchange rate move in the yen, like we're talking about 160. It's getting all the familiar social media treatment. The yen is at a 40-year low, or this is the first time the United States has bought the yen or intervened and bought the yen since 1998. This is the first time since X, type of post we could become used to the last few years. Those headlines are accurate within a limited frame, like I talked about the horse blinders, but the multi-decade chart tells a more useful story. So I've plotted out 13 intervention episodes, including the one this past Friday, on the dollar yen chart going back 40 years, my entire lifetime, which gives you a context. Like these things take up lifetimes or play out over the course of lifetimes. They're that long. Um, but these interventions take place on both sides of, just call it the bumper lane. Sometimes because the yen was judged to be too weak in FX markets, and sometimes it was too strong. And that gets at the fact that this target or this task, to find the right level of a money or a currency, what's its relative value in trade with another group of people, it's a constantly moving target. Um, Policymakers are just like the essentially it's the monetary version of Goldilocks and the three bears, right? You don't want it to be too weak, don't want it to be too strong. You're just always trying to find just right. But over a long enough timeline, you look at the chart and these interventions that we'll get into and talk about in a second. Um, the chart really shows how many interventions there are. That's how difficult this task actually is. So finding permanent stability in a monetary system is about as hard as trying to nail jello to the wall. So as you're looking at this, sorry if you're listening on a podcast, you're going to miss about half of the information because like there's a lot of visual component to it. You still get value out of audio only, hopefully. But I want to start with the colors for each circled intervention episodes, 13 of them, as I mentioned before. So the green ones are interventions when the yen was considered too weak. And the remedy here is to find yen buyers, right? You want to tighten the excessive supply of money, take those off the market, find a balance sheet that wants to hold them, um, and then support the currency. The red circles are interventions in the opposite situation when the yen was considered too strong. So the remedy here is the yen needs to find sellers and issue more money into the system, right? So next, I want you to look at the flags next to each circled event. Um, when a circle has only the Japanese flag, that means Japan's domestic institutions internally, like the Bank of Japan or the Ministry of Finance or related authorities, were able to handle the pressure themselves. Um, that has worked in about half of the episodes over the last 40 years. In the other half, um, Japan has had to call in outside help, foreign institutions to step in. Um, and the important thing, what probably the most important thing that I'll mention here, whenever outside help was required, the consistent partner has always been the United States. Um, there's also an important asymmetry in which partners show up, right? Whether the yen is too weak or too strong. When the yen is weak and needs a buyer, like the situation we're facing today, the United States is the external ally that steps in. So we saw this in the 1991, 92 interventions, again in 1997, 98, the Southeast Asian financial crisis, huge event. Won't go into it here. And then now in the present intervention. Um, it's a solo act. It's U.S. only. We'll get at that more later. So you see that today with Secretary Bessent making the case publicly on the media rounds that the yen is significantly undervalued. So in that sense, the United States here, when it's tapped in to help from the local Japanese financial system and monetary authorities, Scott Bessent is again making the case publicly that the yen is significantly undervalued. So in that sense, the United States once again is operating under a belief that it is buying low, right, and that yen is too weak uh, scenario. All right, so just we'll talk about the level. You can see it on the chart here. We won't talk too much, but it's basically when the yen is weak, the U.S. steps in at the 120 to 140 range. In the 90s, today it's 160. But it's basically okay. So on the yen, it's actually the opposite of dollar-based pricing. First, it's priced in Japanese yen. So basically, what's saying higher number means the yen is actually weakening here.
Right.
So later on, when the yen becomes too strong and FX intervention is needed, the United States, comes in and participates as a profitable seller. So that is a buy low, sell high American relationship with the yen across the cycle, right? Buying low and selling high is what you call actual investing. Hold on to that thought for later. All right. Now, when the yen moves to the too strong side, the external response from foreign help changes. The coordinated yen selling tend to appear after like major downturns in the global economy, risk off scenarios, and flight like the flight to safety type of event. So we talked about the Southeast Asian crisis being a by the weekend. Well, after the fact, the boom turned into bust, and when the yen is too strong, that's when uh, foreign institutions come in to sell the yen, right?
Right. Yeah.
Or say the post 9/11 period, the bust that followed, say the .com boom, once again sell yen, or after the horrendous Tohoku earthquake in 2011, right? The Fukushima nuclear disaster, the natural disaster that was riding on top of that. That drawdown, you saw a lot of uh, need for foreign institutions to come in and uh, intervene on the yen on the short side, right? Too strong a yen. So what we see here, look at the flags. All right, when the yen is too weak, America shows up to help. When the yen is too strong, not just America, but suddenly everybody raises their hand to help, right? EU is in every time. And then in the 2011 Tohoku disaster, you saw the entire G7 come in. So not just EU, not just EU countries, Canada, UK, etc. Were joining in on that one. So that's really the key here, key fact of the matter here. These interventions, number one, they're not uncommon, but the key fact of the matter, when we're on one side of the bumper lane, it's always US coming in buying low. When we're on the other side of the bumper lane, US also comes in and sells high, but everybody else comes in. When I say everybody else, I mean in the post World War II Western coalition, everybody comes in to short the yen at the top. And that asymmetry is actually the buildup that we talk about. Like it's right here on the chart, the yen carry trade. Uh, where do all of the shorts reside? Um, um, so yeah, the so think about the incentive that creates. If you're thinking about the United States is operating as a buy low, sell high partner, everybody else in the coalition tends to be a one-way perma short, right?
Right.
And as a permanent short, your economic like incentives are not the same as a kind of, you can call it a pseudo opportunistic investor that the United States might operate as, buy low, sell high. But think about famous investors on the short side, right? Like Jim Chanos. If you're a one-way short, your incentive eventually becomes to short. Like you want to see Enron go to zero. That's how your position pays off. You're structurally bearish on the asset, on the thing, on the business franchise. But now just imagine that the short seller was funding his position with borrowed capital, right? That's the yen carry trade in a nutshell. Um, so think about it in that framing. This is why the rhetoric and tone around the yen carry trade discussion matters. Look at the chart of these central bank interventions. Those who are willing to sell the yen whenever it's deemed too strong. These are the naked shorts with no offsetting buy low that came before, that preceded their entry, like to their sell high trade. So over time, right? We're talking about lifetimes. My lifetime, grandfather's lifetime. This has been building up since basically the treaties were signed to end World War II. There is a like truly massive amount of capital exposed to the possibility that the yen does not collapse here and keep weakening, but instead strengthens. So if that strengthening forces these short positions to cover, the funding trade moves from profitable to existential very quickly. So a useful rule in moments like this is to watch and listen to who is screaming the loudest, and then in generally, if you pull down those rabbit holes, thanks Tom Luongo for coming up with that rule of thumb. Um, that is going to often tell you who is caught deepest in the vice. So we'll dive into that topic in just a second. Um, so one more structural point here: when the yen is weak and Japan needs foreign help, um, the United States is really the only viable ally. The dollar yen is the deepest and most liquid FX pair in the Japanese financial nexus. So the relevant foreign counterparty, overwhelmingly, it has to be the dollar, right? China might be the like Japan's largest trading partner, and there's a ton of cross-border linkages, even like within the banks and loans between the two economies. But those two civilizations, long history of war, occupation, and like power struggle between these two makes Chinese ownership or like control over Japan's financial infrastructure a complete non-starter. So in this problem set we're facing, it for Japan, it really is right now the United States or nobody. Um, so a little bit more on mechanics. Normally, Japan would support the yen by selling reserve assets to raise dollars and then sell those dollars to buy yen. But Japan's reserves include a massive stockpile of US treasuries. And as we're at the tail end of this old offshore dollar era that I talked about 10 minutes ago, large scale treasury selling that Japan would need to do if it just operated solely on its own here would push pressure back into US markets through higher interest rates. Doesn't mean the US can't tolerate higher interest rates in the future. I'm just saying, like, not right now. Like, we don't need it right now. We'll deal with that later, and we can absorb them, but it's got to be managed on a like, let the volatility escape over time, not all at once. So that creates a direct American interest in finding another route. And so last Friday, what we saw with the first Yentervention move was executed through the Exchange Stabilization Fund, or the ESF, using the direct route. It sold euros and bought yen. Um, there's a signal there as well that we're selling the euro. We won't dive too much into it. But if the United States wants to provide additional support here or from here, those reserves custodied at the Federal Reserve Bank of New York, we need more ammunition behind them, right? If we want to win this tug of war. So the next stage is going to require like other facilities and operate through what we call the indirect channel, right? It's not just going to be pure buying and selling on FX markets. So think about that stage photo op of Besant's handwritten note to buy 5 to 10 trillion of Japanese yen. As it's choreography, right? Yeah. That first 5 to 10 trillion yen from the ESF gets the naked shorts and the yen carry trade rattled, but really it's just a start. So there's going to be more ammunition brought to the table. So that brings us to the next stage of this short-term discussion to the Federal Reserve Bank of New York's FEMA repo facility. So the hot question now is whether the FRBNY's FEMA repo facility. Sorry, there's a lot of acronyms here. I'll just, you'll have to get used to them. There's a question now around the kind of the legal authority and the governance documents on whether this tool can be used for this specific purpose. The other aspect here, this is a COVID era tool, but it has a per counterparty limit right now at $60 billion. So right now, ever since the the $5 to $10 trillion buy last Friday, July 31st. Secretary Bessent is now going out and arguing publicly, making the case not just for using that tool, but he wants the limit raised beyond $60 billion, right?
Yeah.
But
Yeah.
take that in context with that staged photo, handwritten note. There's $5 to $10 billion dollars already deployed, or 800 billion to 1.6 trillion yen, right, as the starter piece, right? Firing up FEMA would bring another $60 billion in ammo behind it, or nearly like 10 trillion yen at that roughly 160 exchange rate. So, like, if you're thinking about this, what the heck's going on? Picture like an old world battlefield, like the movie Gladiator, where the armies are just lining up their massive amount of troops on two sides of a battlefield, right? So that's the dollar yen chart right now. That is the battlefield, and we're gonna see like the two sides here are the yen bulls and the bears. At the end of the day, that's what it is, on opposite lines. And what Bessent is doing with these moves, think about it like that opening scene in Gladiator, right, where Russell Crowe's just lining up all his troops. You're seeing this, like the staging of troops to show the other side how deep his lines are stacked. And so on the opposite side, that you'd call Scott Bessent a yen bull, right? On the opposite side of that, the yen bears, you're not really seeing, oh, we're lining up this many dollars. Well, as I think about it, I could go down a train here and spend 5 minutes talking about who's lining up our reserves on the other side, but I won't go there. But the opposition is really not lining up the troops on the battlefield to meet the show of force that you're seeing with Bessent doing, the ESF, the FEMA facility, actual troops, right? The opposition is it looks to me like they're mounting actions in the public discussion space to pressure the Fed to stand down, right? If we think about Scott Bessent as the general leading the army, well, to go to another one of the generals on his team, Fed, right? If you can pressure the Fed to stand down and take 60 billion troops off the field, you're looking at a totally different war. So that's where the public discussion has gone. And in all this mudslinging, Scott Bessent, Nick Timiraos, looks like Real Housewives, there's something much bigger going on here. But the basic point, get the Fed to stand down, or yes or no. Can you figure out a way through the board structure of the Fed to shut this down? All right. If and when those tactics fail, I think the possession is 9/10 of the law, as well as the law probably lining up with Bessent's side, but we're going to know more as this plays out in the coming weeks. But if these tactics to block the Fed fail, they're going to be left with the choice to either call Bessent's push in of his chips to the center of the table. I know I'm mixing analogies here, and basically engage, or stand down and let the yen appreciate. Like we talked about, the yen appreciation, all the capital tied up in the yen carry trade, it may not be able to weather that. We're going to find out. All right. So mechanically, Japan holds a massive stockpile of U.S. Treasury IOUs in custody at the New York Fed. It's 1.14 trillion. I think they're the number one holder of the listed on the tick reports. All right. So what the FEMA repo facility would allow Japan to do is borrow dollars against those Treasury holdings through secured repo lending. So similar to the basic structure to the repo transaction behind SOFR that we talk about, which is going to be like short-term maturities, overnight, 7-day, et cetera, for money markets. Or think about it like the BTFP in March 2023, where the Fed gave domestic U.S. banks short-term funding, like up to 1 year, to work their way out of the pickle they'd gotten themselves in with the asset liability mismatch that the rising rates in 2022 just blew open potential holes that needed to be worked around. All right, so under this play, we talked about the $60 billion counterparty limit. Japan has $1.14 trillion in USDs or in US Treasuries, so they're well above that limit. And if you think about it, if Japan posts its Treasury bond as collateral, there's going to be a haircut taken. There's no credit risk, right? So if the argument's made this is risky, et cetera, it's like, dude, you need to go study and learn about what you're actually talking about. All right, so that would really what this would actually do. You're creating dollars. You can come in, backstop the weekend, um, while also avoiding outright treasury sales and the resulting pressure that we talked about on U.S. interest rates. But more important, what it would also do, it would give Japan and the BOJ breathing room to continue raising its own interest rates. They'll have more yen capacity on balance sheet to absorb the hikes, uh, which would provide further support to the yen. So that is exactly why the proposal is so dangerous to anyone whose financial racket depends on maintaining a large one-way short against the yen. Um, so at this point, these monetary mechanics and boardroom procedures have like morphed into a political fight over who controls the tools.